there. Let me also welcome in Feroze Azeez, Deputy CEO Anand Rathi is joining us here in the studio, along with Rajat Sharma, CEO Sana Securities, who's also with us in our Delhi studios. Gentlemen, thanks for joining us this afternoon. Let me just get your take on markets as they stand, Feroze. We seem to have shrugged off a lot of the worries in the last week, 10 days, and seem to be smooth sailing. Monsoon is very much on track. The deficit has also narrowed down. So in light of all of that, what are some of the themes that you'd be looking at getting into right now? What would be top of the list?
See, I think you're rightly mentioning themes than sectors. I think there are a couple of themes which are actually doing and actually showing some revival. That's the consumption cycle. The consumption cycle seems to have a reasonable uptake. In the consumption cycle, of course, there are several sectors which get encompassed in the consumption cycle. The first one would be auto, FMCG, media, entertainment, and lastly, hospitality. If you do a good stock pick amongst these sectors, I think you will be able to play out the consumption sector very well, consumption theme very well, and of course after the 7th pay commission there's going to be a staggered benefit to the consumption. Right. Of course there's not going to be one-time benefit, but the 7th pay commission will have some degree of impact on the consumption cycle, so I think one should look at
that's
that
the big theme. All right. But talking about earnings, I just want to come to Feroze on that as well, because we're heading into earnings season. Feroze always creeps up on us sooner than expected. What are you anticipating this time around?
See, I think barring oil and financials, last quarter there was a growth about up to 10%.
Yeah.
I think there would be improvement, further improvement in this quarter, the first quarter of this financial year, to the extent of 14-15% growth in the broader Nifty kind of stocks, and Sensex is certainly possible because the volume growth has picked up and the price deflation is also behind us. So I think about a 10 to 15%, 14 to 15% kind of a growth is certainly possible, especially on lower basis previous years, the same quarter. So I think that'll bring in a lot of forward earnings. That'll bring down the price to earning multiple significantly from a forward basis.
Okay. What do you think, Feroze?
See, I subscribe to the view largely, but there is, like Rajat rightly mentioned, there's a negative correlation between the oil marketing and oil exploration companies. If you're looking from a short-term perspective, you would not want to buy them together because either of them would do good. You have to take a stance and not sit on the fence by buying both of them. But if you're looking at a long-term portfolio creation, there is some degree of hedge inbuilt in buying these two, and that brings some degree of stability to the portfolio. But I think oil marketing companies are definitely quoting at more valuations, so you would rather move from oil marketing to the exploration side, where you're getting better prices to buy and then make a good ride out of it.
Let's talk about infrastructure now. Feroze, that's another theme that you're bullish on. Tell me why. And we've already seen a fair share of order flows now into sort of roads, railways. Defense seems to be a hot favorite, even though it's probably going to again be an area that takes time to really play out. What's looking good to you from the infrastructure?
See, from the infrastructure space, I think there are three major sectors you can look at. Cement is going to be one thing which is going to be a large beneficiary to this smart recovery in infrastructure. Then you have to catch it early. Today there are very early signs of infrastructure recovery. To my mind, cement, EPC companies could be a very, very good basket which you would want to create out of it, and construction material. If you look at these three specific sectors which actually will capitalize on the infrastructure uptake which would be there, and the smart recovery which seems to be cooking up. So I think these are the three things which you can look at.
All right. So from the financial pack, let's get your view as well, Feroze. And we've been talking about both Rajat and Mohit also bringing it up, and everyone's focusing on these NBFCs and looking at getting into finance in a different way. I mean, or into the boom through housing finance, for instance, rather than actually getting into real estate, for example. So what's your take there?
See, I think definitely finance, like Rajat was mentioning, has to be a part of core portion of your portfolio, and the largest portion in my opinion. Of course, you have in the banking space both these PSU and the private behaving very differently, and you have to be more selective on the private sector banks on the contrary, because I think their valuations are significantly higher in the private sector, in the public sector. And I think after this payment banks, there's going to be huge competition which is going to be bringing agility in the PSU banks, which will actually bring in more valuation re-rating. Like an SBI would be faced with a lot of distribution pressures, and I was speaking to some of the analysts, and they actually think that the PSU space will start commanding higher premiums, and I think now it's time to get back to the PSUs, which were actually a beaten down counter.
All right. Feroze?
I would beg to differ here, because I think that's something which has been already known. I think if you discover something new is when you actually deter from getting into these stocks. Their service standards have been low, and I think that's accepted norm. Actually, in a falling interest rate situation, the private sector banks are actually not doing too much of banking. The large portions of their revenues are coming from fee and third-party distribution. These private sector banks are doing a lot of borrowing and lending. I think in a falling interest rate kind of a situation, which is going to pan out over the next 1 year, the NIMs are going to be larger in the PSU banks, of course, because of their large distribution networks. So service standards completely accepted that they are bad, but I think that's done and known to most of the people who pick up these stocks.
Either way, there's going to be a big shift in the banking space, particularly with payments, digitization, and of course, as we see increased distribution. So lots to continue to track there. But we're ahead. Let me get closing comments from the others as well. Feroze?
Yeah, I think of course you have certain sectors which we should focus on. Of course, we have had some contrary views on this show for sure. I would still stick to some ride on the cement stocks, and I think there is still juice left. If you look at only valuations, you might not be able to buy a large portion of the market, because the trailing PEs are almost at 20% higher than the averages since 2000. So just valuations will not give you the courage to jump into stocks, but I think you'll have to look from a forward perspective, because the last 2 years earnings haven't been so promising. So valuations are not going to look attractive in most of the counters, but I think you'll have to gather courage and look at forward Ps rather than looking in the rearview mirror.
Fair enough. Thanks so much for joining us, gentlemen. Great to have you on the show today, and hope you all enjoyed that conversation as much as I did. Let's take a break. When we